Good afternoon or good morning, depending on where you're joining us. Thanks very much for joining for this session, which is going to be looking at the logistics markets across Europe. And we're also going to take a bit of a deep dive, particularly into one market, which is the Central and Eastern European market. The GARBE Pyramid Research is ongoing throughout the year, and it's very interesting to be able to pick this up, particularly as the new research report is published. And I'm very pleased to have Tobias Kastner here, who's head of research and member of the executive board at Garber Industrial, as well as Martin Pollack, who's managing director for Central and Eastern Europe. Let's kick off first of all with you, Tobias. Great to get your sense of where we are in the market at the moment.
Yes, thank you very much, Richard. I'm excited as well to present the 10th edition of the Pyramid Map, and can straight go forward. Because we lost a few minutes, I will skip the introduction slides explaining who we are and what changed in the last few months. Because we just not only Garbe Industrial, but we are a whole bundle of different companies covering all kinds of asset classes and all kinds of services. But let me just skip to the main section where we start off with the pyramid itself. What changed since the beginning of this year in our project? Well, we introduced an additional forecast batch covering now 88 markets from all over 121 markets we cover in these projects. What happened since then? Well, first of all, we always ask the crowd intelligence, the LinkedIn community, how do you see it, short before our session here. And it's interesting to see the different answer and reaction from the people online. In this newest edition, we saw a decline in the share who thinks that the rent development will stay constant, but we saw an increase in rising rents. So this is interesting to see whether this crowd intelligence is matching what's happening in the market as well. When it comes to the yield development, it's even more interesting that many people think that it will continue to decompress and not start with a new investment cycle. So we'll see about it in the next slides. But what is important to keep in mind, what happened in the last quarters or month, and of course the geopolitical disruption or the situation at hand, not only circled around the tariff discussion, but of course it's had a major impact what happened at the market. And we will just briefly look upon some indicators before diving into the details. First of all, on our last forecast that we projected how it will be in the middle of this year, this forecast was quite good. You see no change at all. We hit the markets we forecasted. But when we look at the end of the forecast period, at the end of or the middle of 2030, we see that the situation declined somewhat, resulting in lower projected rent developments and the yield compression not developing as good as we forecasted. Why is it at hand? Because still the world has a peak in uncertainty. And this is even despite the political or the discussion about the trades. You can see it in the blue line is when declined. This is because the people, the companies really don't trust the momentary situation, saying it can change dramatically in the next week. So they still are in a situation where it is uncertain. And this is reflected in nearly every indicator we look at it. And here we have a small give a small insight in our macro market metrics monitor product. It's a different product, but we just think it really fits into the situation. We see kind of traffic light symbolization, and just how you can look at it. The first, we analyze the situation now to the situation 1 year ago and 5 years ago, because some changes can be really short-lived, whereas the other change can be a trend development. So when we look at supply chain and on the PMI manufacturing index, it looks a little bit brighter, but for example, the blue line, but it's still below the 50-point line where the growth is indicated. So it's really this light uptick. Maybe well, we know, of course, the tariffs discussion is a little bit over. For example, the German government has a new was instated with a new chancellor and a new policy. But on the other hand, yesterday, we saw that the French government, well, it's what I said, the situation can change very fast dramatically. So this is what we see in the supply chain and the PMI manufacturing index. We see it again in the sentiment indicators, for example, here for the industrial confidence and the consumer confidence. So this is really on a very low level still. And here we can see the red lights on the traffic light stabilization indicates that the situation is really not improving. So the situation at hand is still the same and or declined a little bit in comparison to the beginning of this year. The same goes for the assessment of the order books of companies producing, for the change of industries. The stock is reduced, so the need for warehouses as well is declining. And on the other hand, and this is a little upside, the construction cost, it's an indicator we forecast and develop, is going a little bit down. But if you look at the situation 5 years ago, it's still highly elevated. So it's not becoming cheaper to build new sheds. So it stays high, even if the pressure is going a little bit down. And when you look at the financing costs, yes, it went a little bit down after the inflation mountains went down when the base rate of the interest rate of the ECB is going down, but it's still, compared to the last investment cycle, is really elevated. So combining it all together, most of the red lights are still flashing. Only a few indicators, even if you look into the future, on the greenish side. So that's the situation the companies are facing, and that's the reason why it didn't improve so much after all. How did the market react? If you look at the vacancy rates, you can see we had the historic low in all the here covered countries, but we see that it is all going down. Martin will tell us later on a little bit about CEE, but the trend is more or less the same for every country. The degree is somewhat different, but it depends on how much product was built in the respective countries. But in our opinion, in most of the countries, it's not dramatically high and can be explained. But of course, we have to keep the lookout for what is happening and react on it. And we see a reaction, for example, when it comes to completions. Here, thanks to Jones Lang LaSalle with their quarterly based monitor of completions, and it's going down. So there's less and less new product coming to the European markets, and the share of speculative developments is going down as well. So this could lead to a peak cycle if the economic development is picking up pace again in the near future. For the investment market, as you can see, it really went down, the total volume, but it's not dramatically below or different from the pre-pandemic age or the average. But of course, we haven't seen the situation, we don't see the activity like we used to in the peak of the market. What's interesting to see is the net initial yields here for two different countries, for Germany on the left side and France on the right side. Just to tell, or to keep in mind that the figures don't really change anymore. It's more or less stays the same when you look at the median of the box plots from 2024 and 2025 in Germany. And on the right side, there's a different cycle in France going on. So it's not all synced in Europe, but you can see it that you have to look into the country itself. And this is again here a different kind of a metric, the capital values, and you can see here the steep increase in capital values short before the peak of the market, and the steep downward trajectory, but already hitting the trough of the market cycle with a slight upward trend. But completely on the right side, you see the market activity, the circles, the dots are, in comparison to the years before, very few. So it's really not much transaction activity which can be noted at the moment. On France, or in the French market, it's totally different. We didn't see the really heights in the capital values like we saw in Germany. So the correction of the market, the pricing was not so dramatically than in Germany, for example. So that's the framework and the situation we faced. What is happening at the moment when it comes to yields and rents? We saw one time again, is this deep increase in the rents and in the market cycles before, and what we are now in, with a big increase of 21% rental developments. Before that, before the Ukraine war started, it was only 8%. But right now, and the activity we see today is only an increase in 4%. So this is really a sideward trajectory. What we said in the very beginning on our title screen, it's between dynamic and between still stand. That's where that's becoming more and more important to look into the regions itself. When we look at the yield developments, it's even more impressive to see we saw a compression of minus over 50 bips before the Ukraine war started, then a decompression of a huge 105 bips, and now more or less no development at all. So the price correction is already done, but we don't see any movement or really the beginning of a new investment cycle. So what I said, it's more and more becoming important to look at the regions itself, because there are still markets where rental developments are increasing. For example, there are such huge markets like Munich in the southern part of Germany, where it's still a noticeable increase to be seen only in the past 6 months. But we saw over 40 logistic regions with minor increases, but it's not only a sidewards development. It depends where you look at. If we look at such kind of map, you can see, for example, that the southern part of Europe is really being very dynamically, especially Spain. There's still development to be noticed. Other markets like Austria, for example, there's really no activity at all, development in the sideward trajectory. Germany, it's totally different between all the different kinds of logistics regions, and for CEE, there we will talk later on more in detail. When it comes to yields, we also see fewer number of logistics regions where already there's a compression noticeable, but it's more synced than the rental development, because it's more like not so much connected really to the region itself, but to the investment market in general. So the decrease in bips is more balanced overall. But there are some regions where we can see there's a slight compression be noticeable, but for the biggest chunk of logistics regions, there's only a sideways development to be seen. Again, this map where we can see more dynamically activity in the southern parts and or the CEE regions, for example, whereas other regions, there's more or less still a stillstand to be seen. So what's next coming to the outlook? When we forecast together with Oxford Economics what is happening in the near future, in the next 5 years, we see, in this case, for the rental developments of 88 logistics regions, yes, there is going to be a rental increase possible to forecast. There's such kind of dynamics, but it will be lower than compared to what we saw in the last years. So it will go on, but with a dampened pace. Left side is within London, right side is without London, because we said every diagram we use for London is because of the huge rental situation there. The diagram's a little bit distorted, so we just took out London and showed it on the right hand side, just to explain that the difference between the top and between the markets is going to be increased. The gap for the lowest regions, the highest regions in terms of rental development is widening. So it's becoming more important to look at the details of the logistics regions itself, the possibilities. If you put it in a different way, for example, here with the dynamics, on the one axis, we see the dynamics in the past, and on the other axis, on the left side, we see it for the forecasted situation. Then we can see for the top 30 market in Europe, where we see logistics regions was fared very well in the past, and which will be the most dynamic one in the future. And of course, on the other side, we see markets which don't develop so much at all. But there are a few interesting points to mention. For example, that it's not only the top 7 countries, for example, in each market. For example, in Germany, there are also markets like Duisburg and/or other markets which are the top tier markets, which from a logistical standpoint are very can be seen with much dynamic. So it's really important to keep in mind, really to look on the statistics. When it comes to the development of yields, here again for the 88 regions, we'll see there will be a compression possible for the different geographic regions. We see this the pace, it will be much slower than what we saw in the past. So by the end of the decade, we won't see the situation we saw by the peak of the market. So this is going to be important when making decisions based on those kind of dynamics. And again, we can see here, you have to view it a little bit differently, because on the lower right side, there are those markets which are developing very good in the past and in the future. For example, some parts in the Netherlands, in the West Brabant region, with this Roosendaal and other markets, but also well-known markets like Hamburg or Munich. And on the other hand, there are such kinds of markets which didn't have a historic good development, but will be newcomers to the markets, a highly developing market in the future. So if you are looking for future good market development, those kind of quadrants is really a good metric to view for investment decisions. A similar kind of way to putting it, again with a box plot, the range from all the European markets in this kind of visualization at the moment and by the end of the forecast regions. Again, there will be markets with a net initial yield from 3.8, but it's only very few markets which hit those levels. Most of the markets which we can see in the green box will between 4.5 and still 5.5. So what are the future demand drivers? Because I said we had lower demand from the companies because of the sentiment not really improving. So there are a few demand drivers everyone is discussing about at the moment. And one of the demand driver, which will be more important, is the defense industry. And we tried to analyze the huge spending programs of the different governments in Germany. Here, for example, for Germany, the amount of billions to be spent, and we asked ourselves, what does it mean now in space? So we made up a potential or forecasting for the demand in square meters and million square meters. And of course, there are many unknown variables within such kind of calculation. So the gap in the lower bandwidth and the upper bandwidth is quite wide. What we can see in the blue circles is the demand in total. And in the green, we try to calculate how much square meters there will be needed from company like ourselves, so for professional investors or developers. And this is only 2.2 million square meters in the lower bandwidth, up to 3.8 million square meters in the upper bandwidth for the next 5 years in Germany. This is because most of the space needed will be built up by the companies itself from owner occupiers, very specialized places, and only a portion of around 20% will be used in regular warehouses like we provide for the companies. A second demand driver is not very new, but it's still ongoing. That is e-commerce. For a few quarters or half years, the discussion was about, well, after the pandemic uptick, the dynamic was really a little bit dampened. So there's not much demand to be expected from e-commerce. This situation is over. And if you can see on the left diagram, the linear trend line, it's really the internet sales is above the linear trend line. So even if the sales went down a little bit after the pandemic, now it is having its original trajectory again, but above the original line. So there's future demand to expect it. And when we see at the demand from the companies, then we can say this is really happening, especially from new market participants, for example, from China, which really don't have any footprint or not much footprint in Europe at all. And the increase for the or the forecast for the retail trade goes in the same direction, that e-commerce will grow up much faster than physical retail. Because some kinds of physical retail, like shopping centers or high streets, are really facing difficulties because more and more people or increase the use of e-commerce or online sales. What are the conclusions just based on the pyramid map? The European logistics property market is in the phase of stabilization after the major upticks and downticks of the market and consolidation. We see an age of cycle of that the cycle of decompression has ended, and now we have stable pricing. But it's really depending on the market itself. So what I said earlier, we really have to look into the market specifics. We see still the potential for moderate rental expectation in many regions, not having such kind of dynamic we saw before. And we will enter a phase of yield compression, but on a very dampened scale compared to the last investment cycle. And it will take some time. And within the next 5 years, it's unlikely to hit those numbers we saw during the peak of the market cycles. And with this, I would like to hand over to Martin, which will give us some insights on the CEE markets.
Hi, good afternoon, everyone. Let me follow up on Tobias and continue with the CEE story and why we believe in this region and why we continue our expansion here and how we are continuing with our activities and what's keeping us the most busy and most optimistic. As you can see on this slide, CEE, specifically larger countries, larger economies as Poland and Romania, has definitely a GDP story. Not only outperformance of the past, but also very positive outlook going forward. That counts also for Czech and Slovak Republic, where you can see comparison with other largest economies in Europe, and where we see that we especially, we can follow up on the next slide with the domestic consumption that goes actually hand in hand with why the GDP growth in the larger countries is so positive, and also the outlook is so positive. We've seen, for example, in Poland, very strong performance on both GDP and domestic consumption in the most difficult years, even in a previous financial crisis in 2008, 9, and 10, and also during the COVID and during the war, Ukraine war start, and inflation. We've seen that the economies with the strong domestic market outperformed not only the region but also European average. We would like to briefly touch also on the infrastructure, not only roads but also rail on the following slide, and maybe to give a bit context also on why we are managing to attract further new supply chain projects, new expansions, why the nearshoring is still the case in Central Europe. And you can see on the motorway expansion chart that again, larger countries, Romania, Poland, but also Czech Republic and Slovakia, managed to invest and extend their network quite a lot. That not only improve logistics and supply chain network, but mainly opens new positions for the developers and for our business, for our sector, and supports new supply and new take-up of industrial real estate. As you can see on the connectivity slide, you can see currently three different routes of the supply chain from Asia, and the transport corridors. Currently, we know what is the geopolitical situation, so we can imagine that the middle corridor is raising on its importance at the moment, and that connects I would say the wealthiest or economically stronger part of continental Europe. It connects with this corridor through CE region, so you can get the goods through this corridor passing Romania, Hungary, Czech Slovak market again, or alternatively Poland. So I think, or we believe, this still this basically continues to support importance of the region, and the key role in of CE in getting the goods from Asia in the most efficient way, and also the most safest way, I would say. On the nearshoring story, this is basically how looks the map, where you can see the regions which has still the highest the green regions, or the regions ranked as with a high availability are attracting the most the nearshoring projects or new projects, new supply chain projects. The tenants are looking at those regions as the places where to go. We continue seeing this on the daily basis, where when currently Western European companies are evaluating the expansion, either these are just pan-European companies or global companies, they see geopolitical risks, not only in Ukraine and Russia, but also in China. Very often they decide to expand into Central Europe, but not to East, not to have those projects and to have new manufacturing plants or new supply chain hubs in the close distance to their Western European markets. And you can still see almost entire Poland on the map, Czech market, Slovak market, most of the Hungary as still something which is the most attractive for growing companies. And you can see also that it's not only about geopolitical situation, of course, but also about the labor, quality of infrastructure, energy costs, logistic rental price, and real estate costs. So all these attributes together make our region at the moment almost a no-brainer when it comes to expanding within the safe part of Europe, meaning within European Union, within NATO countries, or within Schengen countries. We have a case study from one of our properties, which is Nobo Automotive tenant. The Budweis, it's called, it's a České Budějovice site in South Czech, not far from Linz. It's actually 3 hours to Munich by a truck drive. This is the example of a Chinese manufacturer expanding into the Europe and creating new manufacturing plants for their products, which doesn't make sense anymore to manufacture in Asia, and it is more efficient to bring that know-how to Europe, bring that technology and manufacturing skills to Europe, and opening new and new European sites and plants. This is actually quite interesting success story of a Chinese company, because they've been awarded to run also R&D center, European R&D center for BMW car seats. So I think in coming future, very near future, this company will manufacture each car seat or into each BMW manufactured in Europe. And it's actually also a little bit, it can be also kind of an alert that the Chinese companies are not only cheap manufacturers anymore, but they can operate also other way around and bringing their technologies, their know-how, their R&D centers into continental Europe and be competing with older and more established automotive suppliers and companies. On the next slide, we see the customer demand and again the outperformance of the largest market, Poland, but also Czech and Slovak market when it comes to growth of the stock, net take up, new supply. Poland obviously is leading also because of availability of the product, availability of land, easier and faster development process and construction processes, and it's therefore attracting more occupiers. It provides more safety and I would say a clarity into delivery of the new schemes, of the new developments, and is I think doing very good job in attracting not only nearshoring projects but also naturally growing companies and expansions of pan-European companies. We can see region by region, or I would say per cities within CE region. We can see also some data on the performance of particular cities, the rent growth performance, where we can see that almost no region is forecasted as underperforming. You have positive forecast on most of the cities. You have some past underperformance of weaker regions, but I think if you look at each single of them, there is a rational and there is basically a story why this submarket has been having harder times, but they are still in positive numbers and still in the growth mode. And many times and in many situations in the past, they've been able to attract new occupiers, and they've been able to be on track with the market. They've been only sometimes underperforming in the most difficult times in the cycle. But as you can see, Warsaw, Katowice, Brno, Prague, really bulletproof locations which never disappoint, I like to say. And you can see also on our Lofin map that when it comes to Poland, Warsaw and Katowice is really not only our focus, but as GARBE, as data-driven company, we like to make the decisions and our expansions based on the data and not only based on market sentiment, and data basically shows us exactly the same what shows the past, that Katowice region and Warsaw regions are currently where we should be focusing, and they proved over time that they are also very safe and almost no-brainer kind of locations when it comes to holding existing portfolios, when it comes to securing land plots, doing new developments, looking for new tenants, and so on. And I think with this slide, Tobias, I'm handing back to you and for Q&A.
Great, really interesting. Thanks very much, Tobias and Martin, for that. There's a question box. If you look on the right-hand side of your screens in the live stream, there's already some questions in there, and I'll come to those. But if you haven't noticed that, please do put your questions in there, because this is designed to be interactive, and very much looking forward to picking up on what you want to cover as well. Within that, I think there's some quite interesting ones, and I'm going to pick up on those in a second. But Tobias, just coming to you, you mentioned obviously that there now needs to be a bigger focus in terms of, I suppose, drilling down, looking at specific regions, looking at different cities, different areas. So I suppose, what are the opportunities that you're seeing there? Are there particular ones that jumped out at you, or that have come up in terms of the way that GARBE is looking at the data?
Well, yes, we saw moments of the market where it really didn't matter anymore where the location was based, because it was important. There's land plots available, there's workforce available, and there's connectivity, so the vicinity of motorway access. So that was where we saw activities all over the countries, in every well-known but newer places at all. This, for the moment, is not the situation anymore, because investors especially, but also companies, are focusing more and more on sites they know. So the top regions which were known before and are known now. That's why we analyzed our news pyramid numbers, like we did with the quadrants, where we had a historic dynamic situation and a forecasted dynamic situation, just to look upon the metrics where we see an uptick in rental developments, or in a situation in favor of yield developments. This is, of course, the investor's perspective, the landlord's perspective. Then again, there's the perspective from the companies renting our warehouses, and this is a little bit more complex when it comes to the demands from the spaces. For example, we said the defense industry will be one of the future demand drivers, and this is a rather new demand driver for us because and for the industry itself, because they follow different patterns. They don't rent out necessarily in locations where we rented out in the past. So really analyzing where are those industries located, what do they seek from a network of companies and locations it's necessary to make and good decisions in terms to address those industries as well. So this is becoming more and more important to really have a data-driven approach at processing the demands from the tenant and the real estate industry itself. Maybe Martin can pick up on this as well.
Yeah, it'd be interesting, Martin, just to see your take on that. I mean, you mentioned as well Warsaw and Katowice, and those have been coming up in terms of the data-driven approach. So it might be interesting for people as well. Just what's behind that? What are the things that you're seeing in the market that are driving those?
I think especially Katowice and Warsaw. I think there is it combines a little bit the potential of Poland, and there is a little bit of this factor of smaller markets like Czech Republic, because the land is not so available anymore, and I think acquiring good land becomes more difficult. Therefore, building new product becomes more difficult, and that makes the product more liquid. And the occupier market is still strong. So basically, you have, I would say, Warsaw and Katowice, and you can see it also on the data. They provide mix of emerging market where there is a strong demand, but it has these features of very well established markets where the product is liquid and the product is very demanded from both investors and the tenants.
Okay, great. There's quite a few questions in the chat, and to help me, if there's ones that you particularly want answered first, feel free to click on the thumbs up sign, and then I'll know that those are particular ones for you. But let's start with this one. Tobias, probably more for you, I think. Given the global geopolitical situation and arguably the diminishing power and importance of the West, especially Europe in Trump, Xi and Putin's view of the world, do international investors really view European logistics property positively? Interesting one there. I know my view, so I'll be interested to hear yours. Oh, you're on. That's it.
Yeah, I already saw. Yes, of course, it's an important question. On the one hand, is it the discussion about deglobalization itself? Which role do we as Europe play in the future world? And I like to think it this way, that we can't depend so much anymore on either our United States friends than from the Asian countries or the BRICS countries. So the discussion is at the moment refocusing, and that's why we brought in the nearshoring map again, because it's more like de-risking of the supply chain itself. Once again, I'd like to point out our defense demand. A few years ago, most of the hardware we bought in Germany and in Europe was from the United States, and more the situation arises, or the sentiment that we should rely on ourselves, and because we have many companies providing good products here as well. So relying on ourselves and focusing on the huge market we have is a good thing to think of, and to reach out to other markets, for example, Canada, or we recently established a free trade agreement with Indonesia or South America. So we diversify our supply chains in Germany and Europe, so that we not have to face the risk of those aspects. From the investor's perspective, I think we still, but of course we have to be fast, but at the moment we still have a good industry, and we really have a good innovation clusters in Europe as well. So if we use this power to really use it to our advantage, then for the investors it's still attractive. And at the moment it is still the case, because when we talk to our investors, we still see many interest in not only in Germany, but also on products, for example, in Spain. And the capital inflow comes from all over the world, because investors don't know if the United States is still a safe haven for their investments. You never know how the political situation changes from the eastern parts of the world as well. So I think from the investor's perspective is still attractive.
Okay, great. A couple of ones for you, Martin, on CE here. One is, how do you see CE, given the greatest growth potential that you've mentioned in terms of Poland, but if it has a vacancy rate of 8.5% with modern stock, how do you see that in terms of the growth side? And also, just in terms of Hungary and Budapest, if you've got a view on that was a question as well.
Yeah, so obviously, let's not pretend that 8.5% vacancy is not going to go against rent growth. I think it will temporarily put rent growth on hold, or make it not as strong story as it could be. But again, it will probably bring to market new opportunities. It's going to be easier for companies to expand. That always brings something positive, if not for the landlords temporarily, then for the occupiers and so on. Very difficult to find too much positives on growing vacancy, but I think it's probably the most useful to look at maybe 10 to 15 years data and see what has been the vacancy and how long it has been at which level and what was the average. And we will see if we are temporarily above average, or how far we are from some kind of healthy level. On Budapest, it's a bit difficult one for me, because I have a political issue with this country and with this economy and with this market, therefore, and I'm not into it, and very hard to comment further into the details. I have my own experience from the past. I think Budapest is a big city. It's, I think, 2.2 million citizens city. It's the market in the market. I think you can be reasonably successful there in industrial real estate, but I think it's safer if you are Hungarian, and it's probably safer if you know really how to position yourself on the market and how to play with the local rules, I would say. So I'm a bit more against this market, but from the reasons of internationally available data, such as maybe level of some corruption freedom and the way of doing business and things like this. So for me, it's a no-go at the moment.
So not enough data really to help you make those investment decisions as GARBE anyway. Okay, interesting. Quite an interesting one here as well. When it comes to secondary stock, so tailored industrial buildings, what are the main factors that GARBE looks at for investment decisions? This says in Western Europe, but equally interested to find out what that would be in Central and Eastern Europe, if you know where those exist. And the reason for asking that is in the light of land prices, construction costs, lengthy planning processes. So actually, does that make existing stock a more attractive option in some ways than trying to develop new stock or get new stock?
I think it's also a little bit who developed the old stock and how it looks like, how it is prepared for next generation of the occupiers. Sometimes we see on the market only 15-year-old buildings, which are not at all usable for today's tenant at the moment. And I think you can see at the first glance that nobody was really thinking about next generation of the tenants 15 years ago. I think on another hand, if you look at the portfolios of more let's say conventional developers or market experts and industrial real estate experts, I think you will see the signs that somebody, when designing this asset, has been thinking about future of these buildings and the future of and about the next generation of the tenants. So I think it will come down to the seller. If you are buying if you are doing sell and lease back of the building which is 15-year-old, you can expect that the occupier and the seller has been designing it for their needs 15 years ago. If you look at well-established logistics site from I call it conventional developer, you can see it's just a standard product, and 15 years is nothing in age of that product. So I think it will really come down to who is the operator and what you are looking at.
Okay, good. A couple of ones here. I'll try to be brief with these because there's about 4 questions here that I'd like to tackle before the end if we can. One is on the research, which I think maybe again for you, Tobias, is which product types within the asset class have been considered in the data, big box, last mile, city hubs, etc. So maybe useful just to say which asset classes were considered within this.
Yes, of course, it's a question repeatedly asked, and I totally understand why, because everyone wants to know how to interpret the data. If you look on the map itself, it's just a fine print below the map, but you can read it there. Yes, of course, it's a new product, big boxes, so not addressing the older stock, smaller units or very specialized types of warehouses, because it's covering 121 markets already quite a big feat. So really drilling down to different kinds of types. Well, we have some way to go in our research, but at the moment it will be too difficult because the transparency of the market is still to be improved. We want to play our part in it, but it's only for the new products and big boxes at the moment.
Okay, great. There's one here as well, is when considering new developments, what importance do you place on climate risk perils? Interesting. So flood risk for areas, heat stress, and I guess increasingly in some of the other areas, amount of rainfall and those kinds of issues, which I know has been a problem in Spain, for example.
Yes, especially from our colleagues from the financing department, they often have the situation when getting a loan from the banks, and for our existing stocks, of course, we repeatedly have to calculate, or we use products for estimating the different physical climate risks, of course, and it's getting more and more important. So within our data-driven approaches, we look at those hazards in the regions, and so we can identify possible risks even before we are asked to address it by our financing banks, for example. If we know a land plot as an opportunity is within a regularly flooded area, for example, or is in the risk in the future of being flooded, then of course we either say we can't buy it because it's too risky, or it's going to be too risky, or it's a potential that we say, of course, we have to improve the site in terms of securing measurements for additional rainfalls or other risks. So it's a possibility to talk about the pricing, of course.
A couple of ones on CE, but also with an element of Western Europe here. The last couple of questions. One is, isn't the attractiveness of CE even greater because investors mistakenly assume the risk of a Russian attack to be higher in CE than in Western Europe and therefore calculate discounts? So that's I guess whether or not there's a sense of mispricing and therefore future opportunity there. And also that the research shows a clear growth of e-commerce in EU markets. Do you also see occupier demands for urban logistics in key cities, for last mile facilities? And if so, which metro markets, city markets, specifically in CE or SEE, if that's appropriate? So I don't know who wants to pick those bits.
Yeah, I can pick up the first one, and Tobias can maybe pick up the second one. I think it is right that I think when it comes to geopolitical situation and some threats from Russia, I think people in Berlin should not be feeling safer than people in Warsaw. I think when we have the breach of NATO borders, I think we are on the same page, or we are on the same boat, sorry, and we should be acting as one. And I think it's just people are mistaken if they believe they are safer in Germany than in Poland. I think that's not the case. And you are right that maybe the market is a little bit punished for this misperception. And with this logic, almost nothing in Finland or Sweden should be traded at the moment, right? So the same would apply for Romania, for example, Czech-Slovak market. So I think it's a little bit. I think it's very corporate view and very non-Central European view, I would say. And you are right that there is an opportunity hidden in there.
Great. Tobias, do you want to pick up the one about last mile and whether or not there's opportunities there in specific cities?
Yes, yeah, well, not specific cities. Well, first of all, the smaller units, the urban fulfillment centers or similar kinds of products. Yes, there is an increased demand of such kinds of warehouses, especially from e-commerce players with an established network. Those who starts to establish the footprint really start with big boxes to build the foundation of their networks. But with those who already have a network at hand, they tend to increase their density with the smaller units in the vicinity of larger cities where the consumers are located. And this is true for every big agglomeration, like Hamburg, but also other agglomerations, which is highly or densely populated to reach them in a short amount of time. And this is especially happening since market participants like Temu or Shein entered the markets and really put some pressure on established players because they were really fast, they were really cheap, and products which were not making or reaching a profit margin, which some e-commerce players had raised for themselves as a boundary, had to realize, oh, other marketplace can do it. So we really have to think about implementing a strategy to address those products or such kind of product. And they did. It took them some time, but they're starting to create such kinds of closer units to large agglomeration areas or densely populated regions. And this more or less applies to all those kinds of regions.
Great, thanks very much. We are sadly now out of time. Thanks very much for all of your questions. Thank you, Tobias and Martin as well.
Thank you.
For the research report on that, incredibly detailed and really valuable, I think, in terms of the analysis of both the broader European markets, but also that drill down in terms of Central and Eastern Europe, Martin. For those who are interested in the presentation, the slides will be available on our website shortly, and I'll advise everybody of the link for that. So you'll get an email with a link so that you can download those slides as well. Thanks very much to everybody. Thank you, Tobias. Thank you, Martin.
Thank you.
And thanks to everybody else for watching. Thank you.
Thank you.
Bye.
Bye.